Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. Have faith in your mind, have faith in your grind. Invest in yourself, transform in your time. When you trade and get paid, trade and get paid, trade and get paid, trade and get paid, trade and get paid. Oh yeah, trade and get paid, trade and get paid.
All right, so now we're going to talk about leverage. Now, leverage is a much overused and probably overstated word. Not to say it's not important, because leverage is very important, but I think most people just kind of use it as like one of those scary words. Kind of like when people say the trend is your friend, never trade against the trend. Watch that video above. Not so, not so. Now, here's the thing. Leverage is a very, very important factor to trading. But really, it doesn't essentially, make or break you. What really is important is the risk management, what we talked about in the previous set. What's important about leverage is that it basically gives you more buying power than you really have. So when you have like a broker that gives you like a 1 to 10, right, leverage, 1 to 100 leverage. I even see brokers that have 1 to 1,000 leverage. That's a little bit insane. Probably most brokers stop at about 1 to 300. And what that really means is that for every dollar you have in margin, we're going to give you this much buying power. So for every dollar you actually invest, we're going to let you spend $10. Okay? Now, that sounds like a great deal at first, except they trick you. Let me show you what it really happens. So imagine you have, you're going to buy a house. Okay, and let's say that house is worth $100,000. So you say, I'm going to go buy this house. Most banks or lenders are going to require somewhere probably around a 20% down payment. Okay, so in this case, you're going to need to put down $20,000. Okay, now what that means is that you're going to put down $20,000, and then they're going to let you borrow $80,000. So essentially what they're saying is, we will go ahead and buy this house for you. We'll give you $100,000 of buying power for a 20% down payment. We'll give you the other $80,000, but then we're going to charge you an interest rate to pay it back. Now imagine you met this lender. Imagine you met this bank and they said, today's your lucky day. You're going to come in here today. You need to buy this $100,000 house. You have $20,000. And here's what we're going to do. We're going to give you the $100,000 to buy the house, and you don't even have to make any payments. Sounds good, don't it? Be careful, because what seems to be, as they say, like if it seems too good to be true, it probably is. So here's the thing. What actually happens is this with leverage. For every dollar you put in, let's use a 1 to 10 leverage. They're going to give you $10 of buying power. So if you put in $1,000 into an account, they're going to let you spend $10,000. Here's the difference. This is your actual margin, actual money. Here is your buying power and your total account size. Not that you have that much money, but will allow you to purchase that much in Forex. Now, watch this. Let's say that bank allows you to go and purchase this $100,000 house. They say, we're going to give you this money. We're going to let you buy. You don't have any payments. Here's the catch. When you go, let's say you live in the house for 3 years. Fast forward 3 years, you're moving and you're going to sell the house. Here's what the bank is saying. I don't care what the house is worth now. You owe us $100,000 because that's what we gave you, right? So let's say that you went and bought this house for $100,000 of their buying power, their money that they gave you. They let you use their funds to go ahead and take care of this house with a smaller amount of down payment or actual margin. Let's say you bought this house for $100,000, okay? $100K. And 3 years later, this house is worth $175 $100,000. You go and you sell the house, you now have to pay $100,000 back of that buying power. So really what happened is you get to keep the $75,000. You get to keep the 75 because you have to pay back the 100. Your original down payment was 20,000, so minus the 20K, and your profit becomes $55,000. Okay? So essentially what happened is you took $20,000 and turned it into $55,000 using the leverage that they gave you to buy this house. Here's the catch. So now let's say, for an example, you have that $100,000 house, okay, and you move out 3 years later, but now the problem is that the market went down and the house is only worth $75,000. There's a problem, ain't there? Because now, when you sell this house for $75,000, you still owe this broker $100,000. You still owe this bank $100,000 because that's the deal you agreed to. So when you lose money, you now owe the bank $25K. Your margin is only $20K. So now here's what happens. You lost $25,000 that you now owe this bank because of the agreement you made. They gave you $100,000 in buying power for a 20% down payment. You lost $25,000, which is more than your original down payment. So they take your original down payment and you still owe them $5,000. That's called blowing your account. That's the case where buying power or leverage can really hurt you because you didn't plan on spending more than $20,000 of your actual margin investment. So now because you lost more than you had, you now owe the bank an additional $5,000 and you're in upside down. Well, that's the same way things work in Forex. If you have $1,000 of actual investment at a 1 to 10 margin, you have the buying power of $10,000. So let's say you get into a trade that essentially a margin call, thank God for a margin call, we think that's a bad thing, but it'll actually stop you out at about 80% of what your margin is. So let's say you have a margin call at $800. Well, here's the problem. You have a margin call at $800 or 80% of your total margin because you were over leveraged. This, because of the buying power, allowed you to take a much larger position than what your account really allowed you to do. And so at the end of the day, after broker fees and commissions, you might end up with an additional, let's say $100. So now you've lost $900 out of your $1,000. And in one trade, you blew almost the majority of your account. That's where leverage can hurt you. It's very, very important to understand leverage, but not to over leverage or not to overuse your leverage, okay? What you really want to do is you want to come back to that same thing I said before. 1% risk. I don't care what your leverage is. If the broker, all it really changes for you in practicality and in execution is that if you have a 1-to-1 leverage, so they're not leveraged, you're not trading a leverage account, that means on a $1,000 account, your broker is only going to allow you to take a lot size up to so much, maybe 10 cents, maybe $1, depending on your broker. They're only going to allow you to take essentially what you're able to lose, okay? If you're trading a micro account that's only allowing you to take $10 per lot, okay, so on a $1,000 account, you're only going to be able to take $1 lot size. So the broker won't even allow you to take a bigger size than that. So as long as you're using like, a 10 pip stop loss, you can only lose $10. The problem is when you don't use a stop loss and it just goes and goes and goes until you just run out of margin, okay? Now, if that is a leveraged account times 10, well now your leverage allows you to take a position as if you had $10,000. So imagine you have a micro account, okay? Micro, which allows you to take $10 per lot, okay? So think about it this way. If you have $10,000 leverage, it's only really $1,000, but they're allowing you to buy like you have 10,000. So think about it this way. At 10,000 divided by $10 is how much? 1,000. So they'll allow you to take 1,000 lots. Think about that. So essentially on a micro account at $10, they're going to let you take a $10 lot size on $1,000 that you have. So that means every pip will be worth $10 at a 10 pip stop loss. 10 pip stop loss. If you lose, you just lost $100 plus commissions and fees. So if you lose $100 of commissions and fees, even though your account says you have the buying power of 10,000, you really only have 1,000 of actual margin. So you actually lost 10% of your actual account in one trade simply because you were leveraged. You did nothing different than you did before, except that you had a 1 to 10 leverage. Now imagine that on a 1 to 1,000 leverage, where you can get in at 100 or even a $200 lot size and blow your account like that in 5 pips. That's why I'm not telling you not to use a leverage account. What I'm telling you is to use a leverage account wisely. Don't over leverage. If you are taking a 1 to 10, 1 to 50, 1 to 100, whatever that is, just understand that you probably, if you're in a small account, should not be taking long-term swing trades that are going to have a lot of drawdown and where you're going to have to do a lot of waiting. You should probably be scalping at 2, 3, 5, and 10 pips at max so that you're able to get in and out of the market with very minimal risk until you have a larger account that can withstand larger drawdown. So lot size is everything and more important than everything, but understanding leverage is very important because some of you don't know why you blew your account. That's why, because you were over leveraged. I want to encourage you, if you are using a leverage account, make sure you understand risk management and understand how much your lot size of your margin it's actually using, because it might tell you you can take a large position, but should you take a large position? That's another story.